world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by two entrepreneurs making credit more understandable and accessible for people. Freddy Kelly is the founder of Credit Kudos, a new model credit bureau making better data available to lenders. Matt Ford is the founder of Pariti, an app built to help consumers improve their credit and qualify for new products. Pariti was recently acquired by UK challenger bank Tandem, who we've had on the podcast before. To help people get oriented, Freddy's voice is the one you'll hear in response to my first question about how credit scores traditionally work. We've got a number of group episodes lined up over the course of the summer. Let us know what you think of the format. Connect with us on Twitter, at Rebank Podcast, or on LinkedIn, Facebook, or on our website at www.bankingthefuture.com. If you like today's episode, please subscribe on iTunes or your podcast platform of choice and leave us a review. Thank you very much for joining us today. Please welcome Freddy Kelly and Matt Ford. Freddy and Matt, welcome to Rebank.
Nice to meet you.
Thank you very much.
All right. So I think this is an interesting dynamic here because we've got two credit fintech founders. Freddy, you're the founder of Credit Kudos, and Matt, you're the founder of Pariti, as of recently, a full-time employee at Tandem,
yes.
who acquired Pariti.
Yeah, that's right.
Firstly, congrats.
Thank you very much.
I think one of the most interesting topics to get into today for those who maybe don't spend their every working day in the consumer credit space is just to kind of set the baseline. Credit scoring fintech, consumer credit fintech. Obviously there's a play here if companies like Pariti are getting bought. You think about the likes of Equifax, Experian, TransUnion, other large credit bureaus. They've existed for ages. How do traditional credit bureaus work? How do traditional credit distribution models work? And why did you guys see opportunities to do things differently?
So I think the first question is how does a credit score work in the sort of traditional sense? And there isn't like one answer to that, but generally it's all based on past borrowing performance and past application behavior. So I think Experian were the sort of the first credit bureau to set up in the UK, and they kind of transplanted the FICO model from the US to the Fair Isaacs Corporation, which is effectively a model that took a combination of past loan applications, past loan performance, a little bit about the repayment data of those, and a little bit about sort of identity, address, geographic information. And lenders use that information to make a decision. They typically don't use that information in the way we think about it. So we don't just have a score that they say, is Will greater than 700? Yes. Is he less than? Go away. It's generally, we'll take a bunch of data points and we'll feed them into a big model that takes in a load of other stuff we know about previous borrowers and things like that. So that's how it works
And
today.
so what will those data points be?
So, a lot of it is about loyalty, right? So, the biggest indicator that most of these lenders are looking at is, did you repay the last loan I gave you? And if so, I can probably count on you to repay this one. So a lot of their data is about, historical information that they have. And then they blend in bureau data. So, it's important for me to know that you don't have any CCJs outstanding against you. It's important for me to know that...
What's a CCJ?
County court judgment.
All right.
So a default, effectively. So those kind of things they blend in, and then a load of other stuff. So models based on how other customers like you have performed, what kind of behaviours they've exhibited, and how they've acquired you, so what source of you've come through to their platform, that kind of stuff.
Okay, so that's the traditional model.
Yeah, and I suppose there's a number of flaws. There's various flaws, but there's a number of key ones that really jump out, and was a lot of the rationale for certainly my interest in this area and why I originally started Pariti. I mean, the first one that Freddy called out, which is that a vast majority of this is about your past performance with credit. And I think that's clearly a huge issue in many ways, because increasingly people are not taking credit, at the early stage of their lives. So you look at a traditional 21 to 25 or even 30-year-old, credit cards aren't necessarily as popular as they were for that segment. They often may not have used their overdraft at that point. So actually the footprint that they have with the credit bureaus is relatively thin. So even getting on that ladder of being acknowledged by the credit bureaus is the first challenge. And often the problem with that is that the first step onto the ladder is quite a dangerous step, because it's really, really high cost credit that could get you into difficulty. So I think that's the first factor. And the second factor is also the timeliness. So I don't know if you've ever kind of looked through your credit score and analysed it in detail, but it's a really nice historical kind of how well did you do over time. But actually kind of the last snapshot that you got was potentially up to about a month ago. And clearly when your finances are moving as fast as they are, a lender's ability to make a decision about how much can I afford today, actually have I taken out a bunch of new credit, am I a strong risk, am I a weak risk, is very much predicated on often out-of-date information. So that was kind of the second issue that we saw of how can you get a much more timely, real-time view of the financial situation that a customer's in, and how can you start to look at additional data sets that historically haven't been included or haven't really been used as the baseline for credit assessment, to start to either get people onto the ladder or actually to understand those people that are on the ladder, whether they're being mispriced or not recognised for the true creditworthiness that they have.
I think there's also a bigger issue from a customer perspective or a borrower perspective in transparency, right? So there are a whole bunch of lenders doing different things to try and understand risk, from the wild and wacky of looking at, how you behave on a website, where you click your mouse, how you enter a form, whether it's uppercase or lowercase, that kind of stuff, right through to, getting documents faxed in or sent in to you. So they're really sort of grasping at straws in terms of data. And also customers don't really know how they're being judged, right? So, we know maybe that we've got a number floating over our head somewhere, but we don't know how that's calculated. And there's a lot of work, especially in the fintech space, helping people manage their money better, do things, like what Tandem have done or what Entrees did with Matt's help, in the past. But all of that stuff that we know to be healthy financial behavior isn't really directly linked or correlated to credit outcomes and credit scoring. A big part of what we're trying to do is just bring those two things together to say, in the same way that, I get a cheaper rate with Vitality for my health insurance because I wear a Fitbit, can I do the same thing with my bank account and say, this is my bank, this is how I behave, I'm healthy, I save, therefore I should get a low rate on my next credit card or whatever.
So maybe you guys can, because I think there's an interesting dynamic here that Matt pointed out before we started recording, that you guys have almost approached the same problem from two different standpoints, and maybe you can kind of talk us through the individual business models at Credit Kudos and formerly Pariti, just to kind of give us a sense of how we got here.
Yeah, sure. So I guess you could say we're B2B2C in the way we deliver our products. So we work directly with creditors, whether they're credit card companies or unsecured lenders or mortgage companies. We provide data into those services. We have a touch point with the customer, so anyone that goes through our process sees a Credit Kudos branded process. Effectively, it's like a single sign-on process. So in the same way you log in with Google, you log in with our process. We collect data and consolidate data and then build a report. Then we provide that to the lender. The lender pays for it. The way we're tackling the problem is effectively to go horizontal. So rather than trying to say we're a lender or we're a broker, we're saying we're going to provide the ability for a consumer to passport their data across different lenders, and the benefit for the lender is that they get richer data and can make better decisions.
Oh, right. Okay. So in your model, it's the the consumer, the person who's seeking the credit, that actually kind of actively seeks you guys out, shares their information with you, so you can then in turn share it with lenders?
So we work with the lender, so they would choose their lender, and then assuming the lender is using our process, that would be their first contact with us. So we're sort of upfront in that process, and we allow the lender to access the customer's data through that passporting.
Okay. So what data points would you look at over and above the traditional backward-looking credit score?
So we focus our efforts on transactional data. So what I mean by that is effectively your bank statements. We use aggregation. So we're now in the post-open banking era. So we use open banking, which gives us an API connection into the major 9 banks in the UK. We pull out historical transaction history, typically a year. We then consolidate that. We build data points that we return to the lender. So a lot of that is based on credit affordability. We also measure risk based on past data that we've seen. So we effectively say, how much do you look like borrowers we know to be good or borrowers we know to be bad? And we provide those as measures that companies can build into their credit scores.
Yeah. And you're looking at the kind of the value figures on those transaction flows and the management of balances, or you're looking at who you spend your money with and profiling people based on the types of organizations that they're purchasing from, the types of items that they're buying?
It's a combination. So we don't see like SKU level data. So we know you spent 100 quid at Sainsbury's, we don't know what on. But we, on aggregate, we know what people that perform well look like and what people that don't perform so well look like. So it's a combination of things. There are simple risk measures you can look at. I mean, it's important to say a big problem in the credit and lending industry at the moment is affordability, and that's just really a question of understanding how much someone can repay each month. And up until, well, at the moment at least, most affordability decisions are based on statistical data, so like Office of National Statistics data or contributed data based on how many times you've filled in a form saying you earn a certain amount. So just by providing a clear steer on how much someone can afford in terms of repayment, we can do that straight from a bank account. And then beyond that, it's positive behavior indicators, basically. So simple ones like, are you saving? Are you is your monthly trajectory, is that gradient of paycheck to paycheck look good? Are you paying off debts? Are you spending at odd hours of the day? Are you, spending high risk merchants or times or things like that? So it's a combination. We basically look at what is correlative to outcome, and we turn those into features, and we provide those through our API.
Mm-hmm. Interesting. Matt, how about you?
Yeah, I mean, we share a very similar starting hypothesis, really, which is about the power of an open banking data set looking at transactional data. But we took quite a different starting point to that. So the original starting point for Pariti was, let's put customers back in control of their data. Because a lot of customers, or a lot of consumers generally, there is credit bureau data on us, which we haven't necessarily even known about, thought about, or seen, let alone being able to control it or understand how we could improve. So our starting point was, let's actually build a consumer prop. Let's actually get a money management app out into the market that was very much orientated around how can a customer improve their financial situation. You connect your existing banks to the service. So you could connect your multiple banks. Let's say you're banking with NatWest and Santander, you'd pull that together. And the idea being that we'd provide utility to the customer so that they could understand how much money they had, how much money they needed to make it through to the end of the month. And we could provide proactive prompts and notifications and nudges to help get them on the right financial trajectory. And if we identified that they got too much debt, we would help assist with that. But the key part of that really was pulling together the disparate data sets that had previously existed. And the idea being that we almost kind of coach customers through and allow them to use their data much more proactively with lenders that were then integrated into our platform. So we had a partnership with Zopa and with Lendable. For instance, if we identified that customers had got too much debt on too high rates, then we offered a consolidation loan product through those providers. So our view was, let's use that open banking data. Let's put customers in control of it. Let's give them the tools to understand their financial situation and make very proactive changes to it. And then let's work with lenders in a very similar way to Credit Kudos, actually, let's work with lenders who acknowledge the value of that data set as well to then help them make better lending decisions and ultimately kind of better outcomes for the customer.
Yeah. So I imagine the revenue model for Credit Kudos is basically paid by the lender as they help a customer source their information and then provide it with the lender as part of the underwriting process. What about Pariti? What was the business model?
So the business model for Pariti, we were a regulated credit bureau, but we were also a regulated credit broker. So we worked directly with the lenders as well. So if we could identify a customer that could benefit from a particular product, then we took a share of that revenue. I mean, the interesting thing really is since moving across to Tandem. So as you mentioned, Pariti has just been bought by Tandem. Everyone that's not aware of it, we're kind of brand new challenger bank, mobile orientated. We've got credit cards, an aggregation product, fixed term saver, mortgages in the market as well. So a very broad set of financial products. And I think kind of the real key difference being on the Tandem side of the fence now is that actually we're in control of the financial products in our own right. So we really acknowledge the value of open banking data sets. We really acknowledge the value of ultra transparency for customers. So not just apply for a product and then it's like an accept or a reject and we don't really know why, but to start to build consumer products that are clearly linked to the situation that you're in, how you can improve that, and then how you can almost unlock better, lower rates, better value products over time. And that's kind of the opportunity at Tandem. So it's less about a broking model because we are the bank, but it's more about improving our own lending decisions and actually improving kind of the innovation that's in the sector around the actual financial products themselves.
Mm-hmm. You guys have both mentioned open banking a couple times, and everyone kind of has their view as to how it's likely to be most relevant, whether it will or won't end up being transformational. What do you guys view as being the kind of the key pieces here in terms of open banking plus credit scoring, credit broking?
So, I mean, it's one of the biggest buzzwords at the moment. So you can't go to any conference or go anywhere without talking about blockchain or open banking. But I think everyone kind of thinks about, or the starting point of open banking that most people think about is aggregation, which was actually a lot of my background from, I was previously at Ontrees, which is a personal finance manager that we sold to Money Supermarket. And that was actually the core proposition at Pariti as well, which was, the benefits of pulling all your banks together into one place. And I think often open banking has been kind of merged in with the concept of aggregation, but actually my view on the opportunity and the real value in this space is much more kind of aligned to where Freddy is really, which is that open banking, the value of open banking is the access to additional data sets that previously haven't been considered, and they're almost kind of like the enricher and the enabler on top of really great consumer products that we're building. So open banking for me is about how can we provide additional value for consumers by allowing them to connect their additional accounts in, but ultimately to benefit from the additional data that brings to either price differently, to structure products differently, or to actually just provide help and assistance and guidance as they navigate kind of their ups and downs. But yeah, that's how I think about it, which is often kind of quite different to how it's often bundled in the press around aggregation being the primary use case of it.
I'm inclined to agree. I think aggregation and open banking have become somewhat synonymous, and aggregation's been around for a long time, and anyone who wants to aggregate probably has already with screen scraping or whatever tools were available before. And if you look at the way the incumbents are responding, especially those that are in the CMA 9, they seem to be focused on aggregation. I had a conversation with one of the CMA 9 fairly recently where they said, all we're focused on as a bank is getting aggregation, and I think it's the wrong approach. Just because, I think aggregation tools, the end interface is kind of irrelevant as to where you're touching your bank. If you've got the ability now to sort of manage that all over the place, there might be a really good interface that the Centennials or the Snapchat generation or whatever we're calling them go for, and then there might be an interface that that my people my age go for, and it's less about that. It's more about new product offerings and having access to that data and looking at it from a different lens. So, credit is one of those lenses. There's also a lot of thought around comparison. You mentioned Money Supermarket, but how can the role of a comparison or tool change if they have an ongoing relationship with you through your data? You know, can I identify that you're spending too much on bills each month, or, you know, you've got a BT landline and I don't know if anyone has landlines anymore, but if you've got a BT phone and a Virgin Media internet connection, I can consolidate those and save you money and get a commission on it. That kind of stuff is quite interesting. I think we'll start to see that. And also a huge amount of interest in the SME space in terms of what you can do to serve SME businesses better, in whether it's credit or tools or services or insight. You know, if you think you know, big corporations have people monitoring their books, monitoring their accounts all the time and doing smart things. You can use machine learning, AI, plus open banking to deliver that same value for a one-man band. You know, it's an incredibly powerful opportunity.
So, firstly, I don't believe, Freddie, that you're not Snapchat generation.
Have you added me yet?
Doing so now. Yeah, maybe we should start kind of like live Snap. I'm sure there's a word for it. Future episodes. We could tap into a whole new segment of the audience.
Quite possibly.
But well, you guys are. You told me you're based in Dalston, which is like as East London, like kind of like up and coming as it gets, right?
Yeah.
So I mean that like has Snapchat generation written all over it, doesn't it?
Yeah, possibly. I mean, we recently got an M&S, so I think we're gentrification generation now, probably. But
you do have a startup beard, so I mean that kind of confirms the thesis.
Yeah. I leave the beards to my co-founder mostly, but yeah, no, Dalston's an interesting place actually because it's in that intersection. You know, I often hear people talk about some of these startup banks like Monzo and stuff and how their user base effectively like radiated out of Old Street, and I think Dalston's quite on the other end of that spectrum in the sense that, you know, although you've got a lot of privileged, like wealthy people there, you've also got a lot of people that are quite low income. You know, there are a lot of high street lenders. You know, when we first moved in, there were a lot of like loan shops, money shops, payday lenders, doorstop lenders, that kind of thing. So, and I, you know, every time I go to the supermarket there, I someone tries to sell me a credit card or something. So it's actually been quite kind of eye opening in the sense that these products are serving these people, and you know, very often they're penalising them because it's the only thing they can access. To Matt's point earlier.
Well, I mean, it's actually a really interesting point, and you know, maybe it's only tangentially related, but I guess on that note, one of the, you know, potential concerns that gets flagged around, you know, all this data, especially, you know, as more intelligent software is analyzing it, is like, okay, traditionally it was your credit score and, you know, how long you've had your job or lived in your home or whatever. And now it's, you know, how many nights a week you eat a kebab at 11 p.m., like, which correlation with been out drinking after work, correlation with potentially, you know, lower credit score. Like, obviously there's information to be gleaned, which can be valuable to a lender from a lot of this behavioral type data, kind of put to the wrong use. I think, you know, some of that can probably end up excluding people from credit that they might, you know, otherwise or, you know, previously have qualified for. So, you know, I guess leaving aside whether that's a good thing or a bad thing for the lender from a credit risk standpoint, you know, does it potentially reduce the pool of individuals who are you know, qualifying for the tools they need to enhance their lives? And I don't know if this is just the starting point. If you extrapolate out, you know, 10, 15, 20 years in the future, do you end up in some sort of, you know, utopian Chinese system where your, you know, reputational, dystopian, where your reputational rating like allows you to buy or not buy train tickets or something?
I think Freudian slip.
Maybe.
I think that, so the ethics point is probably a separate one to come back to in terms of that kind of, is the wider spectrum of, is machine learning an ethical problem or not? But in terms of the credit, you know, I think it works both ways. And actually, if you look at the market in the UK at the moment, depending on which data set you look at, there's about 12 or so million people that are only using high cost short-term credit. And very often the reason that it's high cost is because the data that those lenders have to make a decision is very poor. And, you know, they're effectively saying, well, the bank said no, we're not going to look exactly the same credit score, Experian or whatever credit data that they used when they said no, and try and glean some magic extra knowledge. And the fact is they can't do that, so they charge a higher interest rate. I mean, that's probably not the only reason they charge a higher interest rate, let's be honest, but it's one of. So, there's an argument that says if you can price those people more accurately, you're actually going to open credit up to a lot of people that are currently excluded. If you look at the way, take the aggregator example, what happens at the moment if you're applying for credit and you're into that sort of high cost short-term credit, so anything 100% interest rate plus, you end up falling down a ping tree, which is like a affiliate network where at each level your cost of acquisition comes lower. So the sort of earlier you're snapped up, the more expensive you are as a lead. And what happens is payday lenders pay the highest price and they don't care, because they'll just sort of spray and pray and they'll buy everyone at the top, when actually at the bottom you've got products that have much lower interest rates, like guarantor loans and that kind of thing, that could give those people a much better longer term solution that just don't get a look in because of the way the market forces work. So you could argue that by opening up data with those people and allowing them to demonstrate financial health more accurately, you could give them a better deal.
And I think it completely depends on the data set that you're talking about, because we are entering a much better world of. We of course have to talk about GDPR, but all the scandals that have happened.
This being GDPR Eve, I think, formally taking effect tomorrow.
We're entering a new brave world, which ultimately, hopefully, will really start to put the customer back in control. Because I think, we all acknowledge that we were out of control of the data that companies had on us, and it's become so evident getting all the new the new opt-in emails that have flown in the last week of just how many companies had our data. You lose track of it yourself, but. Going back to which data set, because I think it's easy to jump on some of kind of the social media or kind of social listening, if you like, data points. But I think actually just some of the core fundamentals are completely missing at the moment, which is what solutions such as Credit Kudos can provide. And certainly the view that we have at Tandem, which is, rent, for instance, has just never really been recognized into a credit score. There's big movements towards that, which is great. But like one of the core debt obligations that most of us pay on a monthly basis has never been acknowledged in a credit score. That is clearly being tackled, and Experian actually doing quite a good job of trying to find ways of doing that. But that's just one small use case of actually there are kind of fundamentals of how we manage our finances and how we run our finances to demonstrate that we are responsible borrowers, that we manage our finances effectively, that actually a traditional lender just can't see. So I actually think that even just some of kind of simple first principle type data sets that just haven't been available are going to have huge impacts really for the customer.
Well, on that note, what are some of the more cutting edge, I don't know if that's the right word, forward thinking, more aggressive alternative lenders doing in terms of the way they're evaluating credit risk? Presumably they're not just looking at someone's Experian credit score. What other stuff are people using today?
So there's a spectrum in terms of sort of traditional lenders. There's a lot of things people don't realize they're looking at. So a lot of behavioral information about your browser, your location, all that kind of stuff the sort of metadata. In terms of more interesting stuff, I think companies like SoFi in the USA looking at educational background, LinkedIn data, the kind of stuff that says, this is where I am today. I'm kind of at level 0, but based on my background, this is probably where I'm going to end up, and sort of forward-looking measures that don't come into a credit score at the moment. I think that's particularly interesting. Payment status, particularly interesting if you've got a lot of knowledge of behavior through payments. We talked about open banking as sort of not aggregation. If you think about open banking as really like a sort of small summarized history of what you're doing every day, it's a more interesting data set, and I think that's the way a lot of people are looking at it in terms of risk.
We're looking at this every day at Tandem, really. So our mortgage is a very smallish part of what we do at the moment, but it's clearly hugely evident that actually the first-time buyer market is incredibly challenging. The property prices have gone up so much. The ability to put together the deposit that you traditionally require, and even have an income that yields the traditional kind of 4 times income that you need to get a mortgage. So things have got to be done completely differently, and I think we've definitely got the appetite to do that, and doing a lot of work internally around how we can start to look at different data points, different data sets, start to kind of build a relationship earlier with the consumer, and actually kind of look at financial responsibility through very different lenses. And I think being a bank gives us that luxury in many ways that we can make our lending decisions, and being a new bank often means that we can kind of do things differently much earlier, which is great. And the same from credit as well. Like at the moment we have a cashback card, which is a relatively premium card. We'll be introducing our near prime card very, very shortly, which is very exciting. But again, like, we're spending a huge amount of time at the moment really thinking about, if you were to do credit completely differently, how would you do this? How would you start to look at a consumer? How would you start to build that relationship with a consumer to get their first step into ultimate? Because credit isn't a bad thing. Credit can be used irresponsibly, it can be lent irresponsibly, but actually it's an incredibly powerful thing that every consumer should have access to as well, to ultimately be able to build wealth in the future, and to do the things that they want to do. So how can you start to structure products in quite a different way? So we can't really announce stuff, but we've got a really ambitious roadmap to start to do that in the next 6 to 12 months.
Nice. We'll look forward to hearing more about that. A lot of people who, again, maybe don't work in kind of the credit scoring space on a day-to-day basis may have come across some headlines recently about acquisitions of the likes of ClearScore in the UK for £285 million, I think, by Experian, and Call Credit by TransUnion at just eye-popping valuations. Or at least what read like eye-popping valuations. Surely there's good justification for those figures. Can you guys enlighten the uninitiated as to why a startup like ClearScore, a few years old, right? With, I don't know how many hundreds of thousands or probably millions of users, but
5 million.
5 million users, 285 million. Where does that value come from?
So I don't know if you... I'd say ClearScore is really interesting. I think retention and customer touch points are the key value for a company like Experian. If you don't know ClearScore well, they're effectively a transplant of the Credit Karma business in the US that's done incredibly well. I think they have something like 10% of the entire US population on Credit Karma now. And they effectively give you your Equifax score, and then they're a broker, and they sell you, they refer you to products based on your score. The really interesting thing they've done well, or the couple of things they've done really well, is obviously user acquisition along traditional channels, so mostly TV advertising and tube ads and things like that, and then engagement with those customers, so keeping people going back and looking at their data.
And it's because it's almost like, gamified is probably the wrong word, but every month they're kind of like reminding, hey, check your
Exactly.
newly updated credit score, and stuff like Mint.com is doing that now also.
Yeah, I mean, ClearScore's done a phenomenal job. But really what they've done is they've taken two quite established industries and kind of flipped them both on their head. So I don't really think of ClearScore as a credit scoring company at all. I actually put it much more closely into the money supermarket category. Yeah. So really what ClearScore is a monthly touch point to find out what financial products you qualify for. And where they've really flipped the market on the head is that Money Supermarket have to pay tens of millions of pounds. The collective price comparison website industry are spending so much to remain top of mind, so that if you want a new credit card, if you want to get a car loan or whatever it may be, actually, where's the first place I should go for that? Oh, I kind of saw this funny TV ad. Maybe I should go there. That's something that resonates.
Or something.
Yeah, so some singing Italian opera singer. So they spend all this money to remain top of mind when you're in the purchase mode of actually requiring a financial product, and then you're browsing to see which ones you're most likely to get. There has been a degree of innovation in the market. So Experian bought HD Decisions, which is a company that gives you kind of information on the likelihood of acceptance for a particular product, but it still required that top of mind approach, which is hugely expensive to get people in to browse for products. Where really what ClearScore cracked was the customer acquisition piece, which was everybody knows that a credit score is an integral part of their financial lives. If you ever need a mortgage, you know that you need a credit score. If you've ever been turned down for a credit card, you probably need to then know why, and that's most likely due to your credit score. And what they generated was a monthly touch point. They realized that people actually really wanted to understand, how's my score changed, how's it moved? And whereas a money supermarket at best has a once a year touch point, perhaps when your car insurance is due for renewal, they actually developed this monthly, if not more regular touch point that's hugely valuable. So, they really flipped it on its head, because actually, A, they've got engagement, but B, it's not just if you remember or if you have seen an advert that you quite like. It's kind of the first port of call that you come to see what products you qualify for.
And I guess they're probably trying to do some hand-holding in terms of enhancing your credit score. How can you get it?
There's a bit of that,
improve?
but this is one of my biggest frustrations with the credit score, the existing credit scoring market, which is, as Freddy kind of alluded to at the beginning, this concept that there is a score is not true. Like every single lender looks at a completely different data set and uses the data that bureaus like Experian, Equifax, Core Credit, etc. have, but build their own scorecards, build their own scores, build their own kind of way of looking at things. So just because you've got a score of 700 doesn't mean that you're necessarily going to get accepted for credit. And I think that's one of the most difficult things for a consumer of, I'm looking at this one number that I might get through a ClearScore, which is still incredibly helpful as a broad barometer of I'm kind of doing okay or I'm not doing so well. And there are, of course, really clear ways of which you can improve that, getting on the electoral roll, etc. But actually, the real opportunity here is to link the actual data that is being used to credit assess you and actually deliver the product that you're applying for and the price that you're going to get and the actual score that you have today. And that's the connection that we're looking at Tandem, which is, can you get a one-to-one relationship between those two things? Can you display maybe it is a wrapped up score, but can you display an indicator to the customer to say, this is where you are, this is what you actually will get today. And if you do X, Y, and Z, you will drop your rates, increase your credit line, whatever it may be, and draw the clear one-to-one relationship between the two.
And try to do that on a more responsive basis than
responsive, transparent, and really put customers in control of that then, and they really know what they need to do then to improve the situation.
It's those feedback loops. I think that's one of the things that the ClearScore and Credit Karma businesses struggle with is data doesn't really update that much unless you're doing bad things or not at all. So the advice they can give you is very boilerplate. It's very, like Matt said, beyond joining the electoral roll, there's not a lot you can do other than get a pay rise or borrow a little bit more money. But if you can, with some of the new banking data that's available, you can say minute to minute how your behavior affects your credit score. You get a really nice tight closed loop in terms of feedback and retention and engagement with the customer. Hey, you just spent more on coffee than most people your age, tone that down, that kind of thing.
That's actually really interesting. It kind of almost brings us back to that point before about how you avoid almost that behavioral profiling of people and kind of preying on bad decision making and or excluding people from credit markets. Because if the credit score is kind of a month on, you're giving me a number, I don't really understand the number, a lender's making a judgment about me based on that number, I don't have transparency, well then suddenly I feel like I've got Big Brother sitting somewhere kind of evaluating my life choices and deciding whether to include me or not in the banking world. If you've got an open, transparent bank like Tandem who's saying, this is how we approve credit. If you did this, this, and this over this period of time, you would qualify for this new line of credit, increased balance, whatever it is. Suddenly, you're actually helping the customer make better decisions, which are going to have positive knock-on effects in their life, which is the same thing that the lender would hope the potential borrower would do to improve his or her credit score. You're just approaching it from a different angle.
Yeah.
Interesting. Guys, quickly, Credit Kudos and Tandem, what are your upcoming plans?
So we're continuing to roll out with more lenders. So we're, as Matt mentioned before, our business model is to kind of work directly with those businesses. So we carry on with that. We're in the process of releasing our consumer proposition. So allowing the customers that go through a scoring process with us to see how that score is being calculated exactly to the point you just described. So you can expect that later this year. Business as usual otherwise.
All right.
And we're moving very, very fast. So at the moment, Tandem's got a premium cashback credit card in the market. We've got our aggregator. We've historically only really done retentions on mortgages, and that's going to be one of the new things that we're just about to start now. So we actually do originations on mortgages. So we'll be getting new customers onto our mortgage book, which is exciting. We're also launching a near prime credit card. So this is really going to be one of the big focuses for the next 2 or 3 months, really. It's very, very, very close. And that's hugely exciting because actually, the vast majority of the UK we're currently unable to really serve with a really strong credit card product. So we want to really think about how to do that differently, how to price it differently, how to incentivize people to make positive financial kind of behave responsibly and provide a lot more transparency using the app that we've got today. So that's kind of the very near-term roadmap. And kind of generally, we've got so many plans really for the next 6 to 12 months. It's terrifying, but generally starting to take a much more active role at the moment because Tandem is it's quite read-only at the moment, so you connect your existing banks to it, and we have a transactional product with the credit cards, but actually we want to take a much more proactive role, so starting to enable automated payments and start to really kind of use a lot of the data, not only to score more effectively, but actually to allow people to move money around much more effectively across a kind of financial situation. So that's going to be one of the really big things for us, and that unlocks everything from savings to automatic payoff of credit, etc. So yeah, big plans.
Great. Well, we'll link to both you guys and your businesses in the show notes. Freddy Kelly and Matt Ford, thank you very much for joining us today.
Thank you very much.
Cheers, thank you.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.